Hey guys, John DeRelay, Head of Revenue Management Education at Wheelhouse, and today we're continuing our Micro Market Magnifier series where we dive into data trends across various markets and really look into how things like pickup and occupancy and rate trends are going to help you better prepare to make the most money you can in 2025. Today, the markets we're going to dive into is the Myrtle Beach area. I'm going to focus on two specific Wheelhouse markets. We do group and organize our markets in a certain way based on the zip codes. And today, we're going to focus on Myrtle Beach and North Myrtle Beach. So right now, I'm on one of the Wheelhouse market reports, which if you didn't know, you are able to access just by logging into Wheelhouse. You can go ahead and make a free account or use your existing customer account. And if you go up to this markets tab, you can actually search for any market in our database and see these overview trends. So lots of data is available at your fingertips. We're going to focus mostly on these high-level trends, but if you'd like to go a little deeper and really investigate specific neighborhoods, specific types of properties, you can go to our sets tool and build your own custom groups of listings to look at their data as well. So for Myrtle Beach, there's a few things that we're going to look at really. So I have the Myrtle Beach market report open, and that's going to cover this kind of southern portion. We also have the North Myrtle Beach area as well, defined in Wheelhouse, and both areas are pretty large. North Myrtle Beach being a little bigger at 14,000 listings, and the regular Myrtle Beach being about 10,000 listings. But together they would be one of the largest market areas in our list of markets. Split up, they still maintain a pretty large net of listings, so we should be able to glean some pretty big trends out of here. And I like to sit on this overview page just for a moment, just to check a few things. There's a few things we can notice, and we are looking at all listings in the area. But between Myrtle Beach and North Myrtle Beach, pretty stable amount of listings when we look year over year. So a lot of areas, particularly post-COVID, have been seeing really large increases in properties. Some of these markets continued to see that through last year, while some have leveled out. And over the past year, it really looks like Myrtle Beach and North Myrtle Beach have leveled out. We're still seeing some growth, but not a significant amount, not in the double digits, not even over 5%. And that's pretty good from a stabilization perspective, because we know that a lot of these markets have been under a lot more pressure this year. And, that growth doesn't help, especially if the growth exceeds the amount of new demand that's coming into the markets. Now, what you can see here is along with that stabilization of listings, we have a pretty stabilized amount of occupancy for the average across the market. Now, the whole market average is going to be pretty low. You have your professional operators, you have your people who are just open for a few weekends, you have your low quality and your high quality. But overall, we're not seeing a ton of occupancy pressure in either North Myrtle Beach or Myrtle Beach. Now, we're also not seeing significant growth either. And at a market average of 42% or 43% respectively, there actually is quite a lot of space to grow here. So kind of staying stable, which if you've listened to any of the other revenue management roundtables or other data things I've been doing, stabilization seems to be the name of the game when we look at data this year compared to last year. Another thing I really like to check is let's break this data down a little. So I can use some of these filters up here, and let's just look at the high performing group. So the high performing group is going to be like the top 10, 15, 20%, depending on the size of the market of listings in terms of their revenue. And what you can see here is we'll ignore the active listing part because we're just looking at a small section. So you have new listings in and out of that. But among the top performers, we do see an increase in occupancy. So top performers in this area are maybe not feeling any pressure at all. They're actually able to drive their occupancy and also drive their ADR to be pretty successful in that regard. So this growth in occupancy is, the average occupancy itself is much higher, but the growth is also much higher. And that means that this high performing group is really taking a much larger market share. When we compare that to the low performers, that's where you're starting to see this pressure, really. They're still pushing and kind of going along with inflation and the rest of the properties to push rate, but they are losing market share to the highest performing stuff. And that difference between the markets, I think, is really important to understand. If you've got really high-end properties, really high-end service, you may be in a position to kind of really push against your historicals last year and what you've done. However, if you have properties that are really in need of an update, you can kind of go to those owners and talk to them about how their segments might be losing ground while that investment actually allows them to gain significantly more ground. Now, if I'm looking at North Myrtle Beach, let's see if that trend also appears. So in North Myrtle Beach, the high performance group, again, has a much higher occupancy. We're seeing the rates kind of climb up over time. However, we're not seeing that same growth on the occupancy side. We're seeing a lot more stabilization, and that's pretty interesting. They're not able to take a larger market share across this market area. When we go to the low, we're still seeing losses though. So this is pretty interesting. It means that the top kind of market group pushing their rate a little bit, not really seeing an increase in the overall occupancy, but the low group is still losing ground, which means that middle group must be taking some of the ground as well, maybe that 60 to 75th percentile. And so while it's not shifting for the group as a whole, if you're on the lower end or you have properties there, or even in the average, you might be losing a little ground as people move into buying the higher quality or better price, better managed properties. Now, let's dig a little deeper into some of the overall market trends. I really like to start with just an overview of the occupancy situation. So I have the trends adjusted occupancy pulled up for Myrtle Beach. And 2023 to 2024 is going to give us an idea of how things have been going, and will hopefully give us an idea of what we can expect when we layer in 2025. So starting out the year, we saw a little bit of growth in the low season, which is always going to be good. Really like to see that. We know that these are really low occupancy times. So any amount of additional occupancy is going to be helpful. And that growth really pushed out into March. So that's pretty interesting there because, when we look at areas a little south of Myrtle Beach, when you get into the Georgia coast and Florida and around onto the Gulf, they've been seeing a lot of pressure in March and spring break in particular over the last 2 years, where those dates are really just not performing the way people expect them to. And as an overall trend, you're kind of seeing the opposite. You've seen a little bit of that growth here really since the beginning of Q1, and then even a little growth into the shoulder season. This is another interesting thing to note. You guys, compared to some of those Gulf markets, seem to maintain a higher occupancy level across all of Q2, where in many cases April and May can drop. So that's pretty interesting, that little bit of growth there. Now, this is where we see things start to skip. Last year, when we hit June and July, we started to see a little bit of attrition in the marketplace, and that's where some of these people were losing their ground. It's an expensive time period to be losing ground in the market, obviously, because the room nights here are worth so much more than the growth over here. But that's where we start to see that downturn. And then into the end of summer, it kind of flips the script again. Things are pretty stable with a few increases. And then we see another trend that was pretty consistent across most of these high season summer markets, which is a tick up in Q4. And that tick up, I don't totally know what causes it. I think part of it might be people moved their stays to cheaper time periods. So you saw a little of attrition during the summer. I also think it has to do with the fact that people's summers for many property managers wasn't as strong. And because it wasn't as strong, they expected the rest of the year to be weaker and lowered their rates early. This is something that I think is a kind of consistent strategic thing, is early in the year, people are really optimistic. And so they push rates a little too high. If that doesn't come in, or inevitably when it doesn't come in, they end up being a little bit more conservative. If that happens in the summer also, and people are cutting in the short term, that second time's the charm, and they actually start cutting the rates much further out. And that actually allows people to purchase when they're looking, not just for the last minute stay, because instead of cutting within 30 days, people have cut 2 or 3 months in advance. Now, if we layer 2025 into this, we only have a few trends to look at, but it'll be pretty interesting. Continuing that trend of January occupancy up a little, but then dipping a little bit in February, but overall remain pretty stable to the 3 years on average. And starting to see some early booking further out, which is good. Now, we're still pretty early in the booking window, so we'll have to see how that builds up. The main one I think to look at is March. And we're looking at March. We see... we're within 30 days of the end of March, so we're in the last minute window, and the market occupancy here is only hitting 27%, which is less than half of what we finished last year at. That's a little bit of a red flag for me. I would expect us to maybe it's possible, like last minute markets can book 50% of their bookings in the last 30 days. I would expect it to be a little bit more like 2/3. So there is a little bit of a signal here that we're getting some resistance and maybe some, trends might be turning down. We'll take a little look at that in a minute, but before we do, let's take a look at North Myrtle. So being that these markets are right next to each other, it's no surprise that we see pretty similar trends in North Myrtle Beach. We have a low season, a little bit of growth, a little bit of stabilization across March through May, although March itself doesn't seem quite as high, losing a little bit of ground in the summer, being pretty stabilized through Q3, and then kicking up slightly in Q4, but not quite as much. So a little bit weaker trend, not quite as in your face as we saw in the regular North Myrtle Beach market. Now, if I add the 2025 data to it, this trend is showing, again, a little worse. So these North Myrtle Beach properties are not quite commanding the same position that the properties directly in North Myrtle Beach are. We see a little bit of attrition in January and February. And again, we see this March pace being less than half of what we ended at last year. Now, this is also interesting. March this year is at 17%, but April's at 13%. I would be very surprised that that gap exists. It seems like a very, very low gap. And my guess here is, well, part of it could be Easter, so we'll take a look at that. But part of it also could be that March is just, like we expect, pacing behind. And, we are in prime time for really thinking about what March is doing. It's really up to us to look and make sure that we put our best foot forward on those properties and don't wait till the last minute. Because if the whole market is pacing behind and you're pacing behind, that means there's going to be other people in that position who are going to start cutting their rates as well. Now, in a good sign here, we do see coming out of May at 10%, it kind of kicks up into June. So we have some early booking here in North Myrtle Beach in June. We should be expecting to see that, but that's definitely a good sign to see even the pace there kicking up a little bit. That's pretty specific to North Myrtle Beach. I don't know what the cause would be, but when we look at Myrtle Beach directly, we don't see that same kind of kick up. So that's something that looks pretty good. If you're in North Myrtle Beach and you're seeing that in your own portfolio, maybe a good opportunity to look into how you can capitalize on it, how you can take advantage of getting your pacing good, particularly if we start to see things have a shortfall in March. Now, for Myrtle Beach, we've been looking at the high performance group, which is a really good idea to get an idea of what the best performing stuff is doing. But if we go and look at the all performers, we can just see if there's a little bit of a change in pattern here. This year, we're looking pretty similar. I think the main differences is we start to see a little bit more attrition earlier in the year. So that means that high performing group really taking some of the market share from the mid and the low. But otherwise, it's generally going to look pretty similar. So why don't we dive into a little bit more specifics and look at the daily occupancy situation. So we're looking at North Myrtle Beach, and what I have here is the current occupancies by day, and I have last year's ending occupancy. And we can use this to kind of glean a few things about what's going on. Now, we see in the short term, end of February, early March, that we are building up some occupancy here. We're still about a little less than halfway there, or around halfway there. So that's pretty short notice. I would expect that we probably should see higher values there because that's a lot to book in the last minute, particularly when we look forward 1 or 2 weeks. So really an opportunity there to kind of just keep a really close eye on how your pickup is going in the short term. I think the biggest thing that maybe concerns me a little bit is if we look at the way these spikes appear for spring break, we have this big spike in mid-March, and that is appearing this year. So that's a really good sign, and it's appearing in a really similar shape. If I look at this, the way that this bumps up a little the week prior, stays a little flatter through the week, and bumps up again, that shape does look like it has a good chance of replicating itself year over year. Now, we did mention, though, when we looked at the occupancies, that it did look like the month was pacing behind, and the place that really seems to be occurring is right here. March 23rd through March 30th. This shape is really not coming together in the same way. We really saw this spike up. We saw this big weekday pattern, and we're just not seeing this year the same kind of demand appearing yet. And this is within 3 weeks. So if you're looking at your portfolio and finding that this spring break period looks really weak, I would start to be a little bit concerned. That's obviously going to be something you want to move on now before you run out of time. Now, when we look past that week, we obviously don't have Easter this year, so we shouldn't expect this to be very high. like it was last year. In fact, it's one of the lowest dates on the calendar. That's something that's really important. If you built your rate plans and you priced in those demand dates without realizing that that was Easter, probably need to rectify that. And really the goal here would be to drive as much occupancy as possible, because there's unlikely to be a lot of pricing power at that time. Following that, though, we have a bit of good news here, which is this mid-April, so April 12th, all the way through about April 25th, looks like it has really good occupancy on the books. And what's interesting there is, Easter is a Sunday. I'm wondering if because people are looking for deals, they're looking for more flexibility, that Sunday allows some travel to happen the week before or the week after, depending on where spring break is falling. So not exactly sure what's causing that pattern, but that looks like it's booking really well and really early. And in some cases, this might make up a lot of losses that might occur here in March. So even though March looks like it's down, this April trend looks really good. And if you can capitalize on it, not only can you make a lot of money for it, but you may be able to both make up any shortfalls for March and ideally exceed them. And since we have a month and a half, you have a lot of time to start experimenting and really looking at this. And I would recommend absolutely looking at Easter and making decisions about your pickup on a weekly basis. Now, I've got North Myrtle Beach pulled up here at the daily level as well. The big thing here, it looks pretty similar to me, but there are a few key differences. One, this pink line seems a little lower compared to last year, particularly in the short term. So when we look over the next couple of weeks, that amount of bookings on the books seems lower to me in relation. And that's a little bit of a concern, as in there's some occupancy slipping here, which means that they may not get to the same point year over year. We do still see the same trends here where this is spiking up. And this is not. So that's really important to note. That Easter week last year is one of the lowest occupancy periods again. So really looking to drive your occupancy there. And then again, we're seeing really strong Easter pickup so far. This one is a little bit more interesting because it's really the week before Easter. That's the strongest. And then we have this little lull here. Both of these had this little lull. And the fact that there is this weekend spike is kind of interesting. It does mean you may need some shorter stays in that time period. But overall, Easter looks like a really great opportunity to capitalize. Another thing specific to this North Myrtle Beach area is Memorial Day. Memorial Day is really spiking up quite well on the occupancy side. And so another opportunity to try to capitalize. I also noticed that when we look back at the regular Myrtle Beach, we don't see quite as pronounced of a spike. So for whatever reason, people are booking more in that North Myrtle Beach area than we're seeing in Myrtle Beach directly. Now, one other trend that's interesting that's different between the two, this early booking we're getting for June is much flatter, as you can tell, which means people are probably holding their Saturdays, they're holding their 7 nights. When you look over at Myrtle Beach directly, you see a little bit more differentiation. There's a few spots that are just picking up with the weekdays not picking up. And that's a good signal where, one, people are willing to purchase these shorter stays. You also see this a little bit in May across every weekend. People are looking to purchase these shorter stays. And two, your competition may be offering some of these shorter stays. So when you look at your portfolio, you need to decide what listings that you can kind of let go out that way, how you can kind of price that so you can try to maximize your income, but also keep your occupancy pretty high. If we look back at regular Myrtle Beach, it's not looking like too many people are offering that, except on Memorial Day. So really interesting. I know this is a market where the length of stays in the summer is a really contentious point. So really trying to develop your strategy to optimize that is going to be key this summer, I think. Let's take a quick look at asking rates. I think that's a really interesting thing to take a look at. So asking rates are the way rates are being posted in the marketplace. So it's what people are advertising. And when we look forward into March, what's interesting is the median rate is actually very similar to what we were doing last year, but there's a pretty big range. And that range on the high end tends to be much higher, right? And then as we move forward, we would expect that this time period where we saw a lot of good, it's right here, a lot of good pickup for April and Easter. We're seeing that the market is pricing that in. We're seeing a much higher price. And then going forward, we're seeing the rates kind of climb up in the summer. Now, there's a few things here that I think are pretty interesting. One of them is, even though this rate is generally a little higher, if we just look at the highest performing groups, what's interesting is ironically, the highest performing groups in some cases, especially in March, they're actually pricing lower in some cases than they were last year. So that's a little bit counterintuitive, but sometimes the best performing listings aren't the ones that charge the highest rate. They're the ones that filled the most occupancy, particularly in time periods where the whole market's not sold out. So you can see here in the high performing top 15, 20% of listings, many of those are actually pricing at or below where they were last year. And many of the dates from last year's high end pricing are higher. When we look at all of the listings together, it's pretty much consistently higher. Even when it's close, it's still a little higher. So that's something to take note of. Another thing I think is outside of this Easter area, we see in the occupancy side that there's some pretty big variations in stay. So the weekdays are not, or the weekdays are very low occupancy. The weekends are definitely higher, but they're far lower than summer. They're not as low as, like, say, a Gulf Coast property management company would experience, but they're definitely not quite as high as, these peaks in March and things like that. If we look back at the asking rates, however, you can see here, and I'll just zoom in a little bit for you guys, that this median goes up consistently through April and May in the rate position. And when you look at this, even weekdays in early April and in mid-May are higher than the rate position that we had in March. And when we look at the occupancy situation, that's not quite the case here, like especially these higher dates in March that do have some peaks. They're more occupied than what we get in April and May. And that mismatch, I think, is an opportunity for people in the market, especially if we feel like March is going to come in a little short this year and we want to make some more up. Now, I'm not talking about the Easter time period. That rate should be higher. But when you look out into this May period, those rates gradually climbing up, you got to question, like, that month doesn't come together that way from an occupancy perspective. So should this rate be a little closer to the March rate, actually? And should the weekdays in these time periods, especially if you can take shorter stays when things aren't booked out, should those be substantially lower? Because the goal here is to steal occupancy market share. It's going to make you more money than being vacant, even if the rate isn't as quite as high as you like it. And you can still protect your weekends. So maybe these weekends should be here, or maybe just more in line with the March weekends based on what we see on the occupancy perspective. But I definitely think that this opportunity is going to be really big. This goes back to what I mentioned earlier, which is we saw a lot of ticking up in Q4 from an occupancy perspective. And I think a lot of that is because some people struggled a little bit in the summer. And so they were more conservative about how they treated Q3 and Q4. I think people need to pull those expectations forward. Really, don't wait until you start to see underperformance. In a lot of areas, we've had a lot more competitive markets for a year now. Start applying those principles that seem to be working in Q4 and Q3 and apply them to spring, so that you can take the most advantage and get the most market share. Let's pull up North Myrtle Beach and see if we're seeing a similar trend here. Of note, I think, is that in this kind of short-term period, North Myrtle Beach is already bringing that rate much more in line. We're looking at the all and not just the high. And those rates are already kind of coming in really close to what people were doing last year. So they've given up any of the premiums that we're still holding way out here in summer. Right? If we go to the high performing group, we see something pretty similar. Those rates are all kind of in line down here, although the high end still is remaining pretty high. We see a similar trend here. We have a lot of pricing power over Easter, but again, these rates through May keep climbing up, even though the situation is in some ways much worse than it is in March. And so that's a good signal to you all, is outside of this Easter time period, these occupancies aren't significantly better than March. Is there an opportunity to take some parts of your portfolio and offer them at a better price so that you can really take more market share on the occupancy side? Again, the difference between weekend and weekday not being very high here doesn't really match the occupancy. And so those are all opportunities, particularly if you can take short stays. Another thing to ask people, especially your owners, if they're stuck on the Saturday 7 to 7, see if they'll let you just take short stays during those parts of the year. So like basically May this year, because it's a lot, April is broken up by Easter. But if you ask them, hey, can we just try 3 nights during May? I think we can make you some more money. You might be able to keep your weekend rate as high as it is and drop the weekday rate and still encourage people to get longer stays. But ideally, the goal here is just to bolster your occupancy situation as best as you can. Now, we see also that the rates start climbing compared to where they were last year. Basically, starting in May, it's pretty substantial and going all the way through summer. This is really going to be a point where I think everyone has to start asking is, depending on how March comes in, how much of a premium do we want to hold for the summer months? My advice would be, if you find that we're already going down to historicals in order to get where we need to go from an occupancy perspective, or even undercutting historicals, you should probably start making those moves now, because the whole market may be pricing in too much of a premium for the consumer. The consumer may not be able to absorb a big premium, especially if the property isn't top in the market. And if you're waiting with the rest of the market to make those changes, then you're all going to be competing together as you're cutting your rates. So if you're finding that that pacing in the spring is sluggish and you already have to cut those rates substantially to get them filled, go ahead and start looking forward from May, June, July, and see if you can start bringing those rates down now, and bringing them closer to your historicals. And if you start to pace well, you can bring them back up. I think that's a really good approach to take, particularly if you feel like the markets are really volatile or unstable or could be worse this year, because you're always going to feel better having filled your properties and thinking you left a little money on the table on the ADR than having a bunch of vacancy. The last piece of data I kind of wanted to share with you guys is some really cool booking window data that we have on the back end of Wheelhouse. If you'd like to look at us together, we're happy to pull stuff up for you. But what I have here is for the Myrtle Beach, I'm looking at the stays for the summer. So people staying from June 1st to July 31st. And we're going to be what it's going to do is it's going to count up the number of bookings that have been occurring each day to give us the sum total number of reservations. And it's a good way for us to, one, visually see a booking curve and see how bookings come in over time, but two, also check some pretty key time periods to get an idea of how things are pacing this year from a pure reservations perspective. And there's a few points that I like to look at right now. The first is, let's just kind of see where we were on December 1st. So we go to December 1st, we were at about 6,000 reservations on the books, right? So you can see pretty small proportion of the total number of reservations that actually stay in the whole area. But from a gross reservation perspective, that means bookings are coming in. And that December 1st time period looks like, if we look on the chart, it's a little bit before where this starts to kick up and roll forward. Now, let's hop all the way to January 1st. If we hop to January 1st, and keep in mind, this is 2024, that jumps up quite a bit. It pretty much doubles and goes to 13K. So now we've got, a couple percent of our total occupancy on the books for this whole time period, and a big jump up in number of bookings. Now let's hop over to February 1st. So when we go look at February 1st here, that makes another big jump, almost 3x to 42,000 reservations already on the books and almost 10% of the total occupancy for the summer months. Now, those are starting to be pretty big jumps. You can see here around January, early January, you see a really big tilt up in pace. And that just remains pretty sustained all the way through May. So this would be the time period we really want to make sure that we're pacing and making sure that you kind of catch up on pace if you're behind, because you're just going to keep stacking on more reservations, and it has to be pretty much consistent for all the way through. So let's look at how that started to come in 2025. Already you can see we have a pretty different looking chart. Obviously the axes are different, so that affects it a little bit. But let's hop over here to December 1st. So December 1st. December 1st of 2024, 4 stays in 2025, we were only at 49.95 bookings booked for the summer already. So that right there we're a little bit behind. We're not a ton behind from a percentage wise, we are, but this is such a low percentage of the total bookings. But we are starting a little behind. So this early booking that happened before December, just a little bit sluggish. Now, we're not looking at room nights, so it could be that there's more room nights booked. We don't know, the long-term stays. We're not looking at the rates. We're just looking at a gross booking value, because what that gross number of bookings, because what that's telling us is just how many people bought. Last year, 61,000 people purchased something. This year, only 49,000 had purchased by that point. Now, let's jump over to January 1st. January 1st. So if you recall, last year, by January 1st, we were at 13,000 people had purchased a reservation for the summer. This year, we're only sitting at 6,873. So we're really starting to fall behind in the number of people who have purchased already. Little bit of a red flag. Again, though, 6,800 is not a huge proportion of the overall bookings. And what's interesting, as you can see here, is the amount of pickup in January picks up really, really dramatically. You see a huge increase in pickup, more so than like this slope here, which stays pretty consistent. And so even though we're starting behind, by the time we get to February 1st, we've made a substantial increase in the number of reservations. I mean, this is like 4x the number of reservations, where we really only had put on 3x the previous year. The downside of that is it still leaves us a little behind, because while we've gotten to 25,000, last year we were at 42,000 people had purchased by this point. So the market is falling further and further behind, even though the percentage rate of sales is higher. But this is something to keep in mind, is when you're looking at your own pacing, it seems like less people have purchased in the market so far. We have a lot of time, so that could change. We do expect booking windows to potentially be a little shorter. But if you recall from looking at the rates, part of it could be the market is pushing rates that are too high compared to last year, or at least too high for the consumer. Now, another small thing here is you see, we've maintained this really strong kind of pace of bookings, but it does level off a little bit. That might get drowned out as more time goes by, but something to just be aware of is that the pacing for the market is starting out a little bit behind right now, and from a reservations or people purchasing perspective, and it looks like it's going to be really finicky. So, now is the time to really be paying attention to what's going on in the summer with your pace, where your rate was compared to last year. And even though you may really have to make some moves for the spring, just do your best to get the heads in beds and focus on where you might be able to make the biggest impact. And I think that's going to be getting your summer rate right for the consumer. Now, right for the consumer may not be right for the owner. The owners may want to make more money, but at the end of the day, it's the consumer that's going to drive what the properties are worth. And you got to make sure that you are pacing for them, because if you end up substantially behind in the short term, you're going to potentially be competing with a lot of other people in that same situation. And I do think another big opportunity is finding those dates in spring where you can really optimize by driving occupancy. Anyway, I hope you found this data really helpful, really insightful, and useful for you in planning for what's coming up in 2025 and really maximizing your revenue. All of this data, except for that booking window stuff that I pulled up, is available directly to you on Wheelhouse. All you have to do is sign up and log in, and you can access the market reports for any market in the country for free. And if you want to go deeper and look at really specific neighborhoods or specific groups of listings, you can use Wheelhouse's dynamic sets to do so. If you'd like some help with that, please contact our team. We'd love to walk you through how to use these tools and talk to you about how Wheelhouse might be able to help you make more money. In addition to that, if you'd like to pull up your own data and look at it against the market and look at it together with a revenue management specialist, contact Wheelhouse. We'd love to set up a call with you because we want you to be successful this year. Thanks and have a great day. Bye.